Most foreign founders pick the wrong structure first and pay for it later. This video reveals the real cost of a Dubai limited liability company. It shows how you can own 100% of your business. This video comes from Best Solution, a specialist since 2003, forming over 5,000 companies. A Dubai limited liability company is a mainland structure. It separates your personal savings and property from company debts. This structure supports 1 to 50 shareholders. The Department of Economy and Tourism licenses every mainland structure. Your company operates entirely under the United Arab Emirates Commercial Companies Law. This ensures full legal compliance. A mainland company trades directly across all 7 emirates and the wider Gulf. It can bid for lucrative government contracts that restricted free zones cannot reach. You require no local distributor. Most commercial and professional activities now permit 100% foreign ownership. You need no MRIing partner. You need no nominee arrangement to operate legally. Limited liability shields your personal assets from company debts. This single protective feature is why founders prefer this structure over a sole proprietorship. A mainland setup avoids the 5% customs duty on local trade. Free zone goods pay that duty when they enter the local market. A mainland company has no cap on employee visas or property ownership. Department of Economy and Tourism regulation elevates your standing with banks and large clients. Higher initial setup complexity buys ultimate operational freedom. Your chosen license type strictly limits your legal business operations. A commercial license covers trading and retail. A professional license covers consultancy and services. Industrial and tourism licenses cover manufacturing and travel. Let us examine the actual financial requirement. Year 1 costs run from 22,000 to 35,000 dirhams. This total includes the trade license, registration, residence visa, medical test, Emirates ID, and mandatory Ijari office lease fees. The base license fee is rarely the financial surprise. Immigration fees and office requirements add up extremely fast. You must compare comprehensive business models rather than basic license sticker prices. A standard setup takes 3 to 5 working days. This timeline assumes your documents are perfectly prepared and complete. Several specific factors stretch this timeline. Regulated activities and external approvals add waiting time. Multiple shareholders or international corporate shareholders also extend the review process. Step 1 is choosing your exact business activity. This choice must match the approved government list. Your activity directly drives your required license type. Step 2 is reserving a compliant trade name. Your name must fit your activity. It must avoid any offensive, political, or religious references. Step 3 is drafting and notarizing the Memorandum of Association. This legal document sets out shareholder rights. It defines your capital structure and business scope. Step 4 is securing initial approval from the government. The Department of Economy and Tourism must confirm your activity and ownership are acceptable. This step halts all progress until the state grants approval. Step 5 is leasing a physical office space. A physical address is mandatory for a mainland company. You must sign a tenancy contract and register it through the Ijari system. Step 6 involves securing necessary external approvals. Some specialized sectors require extra sign-off. Bodies like Dubai Municipality must approve healthcare, education, or food businesses. Step 7 is submitting your final documents and paying the required fees. You then collect your operational trade license and commercial registration. Step 8 is opening the corporate bank account. This account enables you to deposit capital and run transactions. It is required to sponsor employee visas. You must prepare shareholder passports and your notarized Memorandum of Association. Add your initial approval certificates and your Ijari lease. Heavy administrative readiness keeps the operational launch timeline to 3 to 5 days. You no longer need a local partner for standard professional and commercial activities. Full foreign ownership is the standard today. A few regulated exceptions remain. Defense, security, and strategic transport sectors still mandate local partnerships. The requirement depends strictly on your activity. A mainland company trades locally and bids for government work. A free zone company focuses internationally, requiring a local distributor. Map your jurisdiction to your long-term goals. Do not base this decision on immediate setup price. Securing the trade license is rarely the true obstacle. The corporate bank account is your actual operational bottleneck. Banking delays usually begin at formation. Banks evaluate your business using a strict consistency chain. Your business activity, license type, shareholding, and website must perfectly align. They must tell one logical story. A mismatched narrative triggers enhanced due diligence immediately. A consultancy license paired with an e-commerce website is a common error. One single inconsistency will stall banking access and freeze company liquidity for weeks. Apply the 80% rule to your formation strategy. Match your corporate structure strictly to where 80% of your first-year revenue will originate. The most common error is choosing a license purely by price. The cheapest license often creates a flawed structural foundation. Underestimating recurring visa and renewal cost is a dangerous pitfall. These hidden operational expenses can easily cripple your year 2 cash flow. You must identify anyone who owns or controls 25% or more of the company. You must file an ultimate beneficial owner declaration to maintain compliance. A 9% corporate tax applies to most mainland companies. You pay 0% on profits up to 375,000 dirhams. You must register for anti-money laundering compliance through the federal system. Value-added tax registration becomes mandatory once your taxable supplies pass the financial threshold. There is no fixed minimum share capital for most activities. However, your declared amount must logically support your intended business operations. A mainland company requires a physical office registered with Ijari. Utilizing unverified virtual offices to save real estate costs frequently results in outright license rejection. This is a common observation for the advisors at Best Solution, a firm having formed over 5,000 companies. Treating formation as a strategic choice costs nothing extra. Administrative mistakes cost months of time and thousands of dirhams in recovery. Here is your first takeaway. Match your license strictly to your primary revenue source. This settles your jurisdiction, banking, and compliance path immediately. Here is your second takeaway. Budget for your total first-year financial reality. Factor in immigration, visas, and office costs rather than just the base license fee. Here is your third takeaway. Structure the company to pass banking due diligence from day one. Maintain absolute consistency across all documentation and online presence. Secure your structural foundation today with Best Solution. They operate with a team of 50 specialists from Business Bay in Dubai. Walk into their Business Bay office for a completely free consultation. Do not let the wrong decision cost you more time and money later.